What up, guys? It's June 10th, and we got stuff to talk about in these markets. We got to get serious, okay? We got to talk economic data, macro data, what's going on in the world, what's going on in the U.S. with inflation. We got the CPI data today. We're going to talk a lot about that and kind of like the forward-looking view of the markets following this data today, because there are some changes today, some things we have to consider and posture ourselves for the future, okay? So before we get started, please hit that like button, hit subscribe. Hopefully you get something from these videos, you learn something, and we have some fun in the meantime, okay? Let's get to it. All right, so here's the action for today, guys, okay? Here's the Friday markets. We have the Dow Jones falling by about 2 3/4%, almost 3% of the S&P. The NASDAQ, ouch, almost, not almost, 3.5%, and then 2.25% for the Russell. VIX moving up in the upper 20s. Okay, remember the VIX mark that we like is the 30 mark to do heavy buying, okay? But recently, because of the way market's been, I don't foresee the VIX being that affected with all the damage that's already been inflicted on the markets. So I'm not necessarily watching the VIX, but overall, we always watch the VIX. The closer to 30, the more it is over 30, that to us are buy signals to buy the market for the long term, okay? And of course, this is us, okay? This is fine. This is pretty much all long-term investors right now, options traders, whoever you are. I think this is you right now, okay? And just kind of just sitting there saying, this is fine, you know, because this is going to pass. But when does it pass? Who knows, okay? So let's move it on. So today, of course, we have the consumer price index, okay? That's the measure of inflation, probably our favorite measure of inflation, the market's favorite measure of inflation, and it measures a basket of goods and how they inflate in price year over year and month over month. We're going to go over the year over year numbers. Those are the ones that really matter. So it came in at 8.6% year over year versus the expectation of 8.2. Very, very hot read. Wow, so disappointing. I was hoping to see maybe some kind of flattening of that curve, but it's just higher. And it's just a disaster, guys. It's no bueno, no good. Core CPI, that excludes food and energy, right? Pretty important categories, if I say so myself. Came in at 6% versus 5.9%. So, of course, food and energy, the major drivers of inflation. Of course, if you want to look at the Consumer Price Index, you can go to the U.S. Bureau of Labor Statistics, their website, bls.gov, and they'll give you the change here. And you can see here on the release the major drivers of inflation: fuel, oil, gasoline, energy. These categories right here, that's your big daddies right there, giving you that big bump on inflation. Everything else is sort of, more tame than these numbers, but the numbers are just too crazy here in comparison to everything else you see here. So again, the biggest concern for me when it comes to inflation are energy prices. And if you've been invested in energy stocks for the greater part of this year or even beyond that, good for you, because you're making a killing, and we're going to go over that in a second. So in keeping in the topic about inflation, we need to know what's going to beat inflation, okay? What's going to make inflation go away? So I want to go over a couple of things so you guys understand. If you guys don't follow the news, if you guys don't follow the macro trends of the economy, you need to know what's going to get us to where we need to be. So the Federal Reserve stops, these rate increases and just it kills demand, okay? So let's start with that. Let's start with energy prices need to go down, okay? So oil and natural gas. You'll see here the price of oil, natural gas. Let me bring that up over here. Here we go. WTI crude, West Texas Intermediate crude oil price for the 1 year chart. Look at this, guys. We got a 1 year chart here. If you look at the five-year high and then all-time high, look at that. This is the financial crisis back then in 2008. For those that are old enough to remember the financial crisis, you're hitting that high there on that financial crisis. So very important that this number come down so money starts being siphoned out of there back into the real economy, back into the pockets of regular folks like you and me, okay? So the other thing that we need for inflation to get beat is the war in Ukraine needs to resolve, right? This is, we're talking about supply and demand of oil, and has everything to do with oil for inflation to kind of become more tame and back to the Fed's target of 2 to 3%, which at the time kind of just seems laughable that it'll go that low, okay? But at the same time, Russia was supplying millions of barrels per day. I think it was 4 to 5 million barrels a day that Russia was supplying before the war started. Now, none of that is getting out there. That supply needs to come from somewhere, and it's just not, okay? And we'll talk about that in a little bit. And then, in addition to Ukraine, the red-hot housing market needs to cool off, okay? The supply of housing needs to increase. It needs to increase. I think that that's a little bit easier nowadays because we've seen commodities like copper, like lumber, crash completely recently, which I think works to the advantage of the home builders. But at the same time, there's probably 1,000 different things out there. Labor, we're talking, cabinets and things like that come from China that are not coming on time. Those need to come in, and the supply of those things need to increase so houses get cheaper, especially the new houses. Also, people need to start selling their homes, and I've seen that around my own neighborhood. I've seen people selling houses, and all of a sudden I see 1, 2, 3, 4, 5 houses pop in my neighborhood, and they're selling, and some are selling, some are not actually. The ones that are not selling, they're dropping the price because the interest rate now, the mortgage rate, is so high that people are out of the market. They're priced out even further. So you can't expect the price of a home to be that high and the interest rate to be that high. Something has to give. So the supply of buyers goes from this to this. All of a sudden, now your house isn't getting sold. So in order to incentivize a buyer, you have to take down your asking price. So if you haven't sold your home yet and you're thinking about selling, I think you need to hurry and put your house on the market because the market is going down, the housing market. And that's, in my opinion, that's what I've seen out there in the economy, okay? The next step here is the Federal Reserve needs to bump its aggressiveness, okay, in order to kill demand. We're talking about these quarter-point rate hikes, these 0.5% rate hikes that the Federal Reserve has done. Not enough, okay? I've heard several people today, several expert economists calling for 100 basis point increase, a whole percentage point increase in the Fed funds rate to bump it up, right? To increase it, to kill even more demand and just shock the system. I don't necessarily disagree with that. I think that actually might be a good idea for the Fed, which is expected to do 2 subsequent 50-point basis hikes, to just go straight to 100. Just do it. Just get it over with and kill demand even further so we can get to reset and get to just land. Not even a soft landing, a rough landing, but allowing the economy to take back off, okay? There's going to be some damage done there, but the economy can absorb that. I really believe it can, okay? The other point here that we're trying to make is China needs to reconsider its zero tolerance for the Roni Rona, and get back to business as usual. China, God, what are you guys doing out there? Anybody in China watching this? Probably nobody, because YouTube is going to be blocked and the PRC doesn't want people saying what it is. But what are you guys doing over there? Get back to work. Use the the Moderna. Use the Pfizer's. Use all those guys, because you're not, and it's costing you big time. So get it together, China. That's all I gotta say. Get it together, right? And then, of course, the supply and demand imbalances need to balance in the U.S. and abroad. So this is essentially the bread and butter of what needs to get right for inflation to get under control in the U.S. and actually head in the right direction, all right? Now, I want to move on to the most pertinent point of the inflation read, which is oil, okay? The issue with the price of oil. And I kind of brought this up. I was kind of making this, and I thought, how can I best explain the situation with oil without making it political, without blaming somebody, okay? And it's kind of hard to do, to be honest, because I always find myself blaming oil companies, but really blaming them does nobody any good, because they're not doing anything wrong. They're not doing anything illegal. They're not doing anything against anybody's rules. They're protecting their own interests, which shareholders expect their companies to do. As an investor, I understand this. As somebody who watches the economy, who is in touch with economic news and eco data, I understand this now more than I ever have in my life. It's very easy to jump into, demonize a business and an industry, but at the end of the day, everybody kind of watches out for themselves. So the issue with the price of oil, okay, so it's about incentive, right? What incentive do oil executives have to really increase production? So think about it this way, okay? You're a shareholder of a company, of a major oil company, and I am an executive, and I'm trying to get your opinion as to what we can do, and I'm giving you several options. I'm giving you option one, which is, hey, do you want a windfall of cash in your pocket or not? That's option number one. Option number two, hey, do you want to make a patriotic commitment to increase supply, increase drilling by capital expenditures? That's that CapEx to increase oil output and increase supply, thus dropping the price of oil. And of course, option one, we're seeing that's what's happening at the moment. That's what these shareholders and execs are electing to do. So they're increasing regular dividends. They're giving special dividends even in some instances in some oil companies, and record share buybacks, which in turn increase the price of the stock. And happy shareholders, those energy shareholders, guys, happy. Everybody who's holding tech, sad, depressed, just all kinds of bad on the tech side and on the value side. Very few places to hide besides oil. But what are you going to do now? Go and sell all your tech stocks and your value stocks, your financials, and buy oil stocks? That ship has sailed. Everybody who's in there, needs to be in there for the dividend now, and that takes time to kind of realize. Okay, option number two, we're talking about that you can't shift profits, right? Or think that they're going to be okay with shifting profits to hire more workers, more rig workers, and buy drilling tech from Schlumberger and Halliburton, which are the providers of those drilling technologies. Those cost money. And increase of supply to trigger the Saudis to do the same. The Saudis are going to do the same. If we increase, they're gonna mimic what we do and increase supply as well. So what do we expect them to do? And then the increase in supply causes the price of crude to drop, and then it hurts your stock. It's a no-brainer, guys. I hear a ton of arguments about, well, they can't drill because the administration doesn't let them drill. It's like, no, stop. Think about it this way. If the administration or whoever has the authority to let somebody drill said, drill anywhere you want, drill my mom's backyard right now, go ahead and do that. Do you think that the shareholders would say, let's go ahead and do that now because now we can drill in the Wall Street Roosters' grandma's backyard? It doesn't work that way. They're not going to all of a sudden choose to drill because now they have all this space to drill. It's not about space. It's about the willingness and the incentive to do so. Okay, so I wanted to give my 2 cents on the issue of oil. Now moving on, and everything is not bad. Okay, everything is not terrible, and we're all going to go bankrupt and lose all our money. Everything is not all bad. There are signs that things are improving, and let's go over those signs real quick. So, of course, the opposite of inflation is deflation, and we're seeing signs in the economy right now. If you're looking hard enough, if you're listening to conference calls, if you're listening to companies, you're seeing signs of this deflation, okay? We're going to start with Target and Walmart. Too much inventory, okay? They ordered way too much inventory, the wrong kind of inventory, and they've guided down on their margins. You can listen to this in their latest conference calls, and their stock prices have seen and paid the price of this excess inventory. Excess inventory, like I said, guides the margin down, which they've done, and it causes the price of products to decrease. When you have major chains, major retailers like Target and Walmart, what bigger retailer can you think about in the U.S. than Target and Walmart? Every other retailer that competes, all the little smaller ones that you can think about that competes with Target and Walmart, they're going to have to match prices or beat them, or they're going to have to compete for that business. And how do they do that? They're going to have to drop prices as well. So whatever Walmart and Target does in dropping prices, somebody needs to catch up to that, and that is deflationary in itself. So that is good news for the overall deflation story, okay? Now, we're seeing home prices dropping as mortgage demand hits a 22-year low. Let's talk about that a little bit. So here we have an article by CNBC talking about the lowest level in 22 years, guys, and this is insane. The lowest mortgage demand level in 22 years. We're looking at a refinance demand dropping 75% year over year. Us Rocket shareholders, not good, but good, right? Not good for the stock, but good if you're going to buy the stock at a 22-year low as far as mortgage demand. In a couple of years, when this normalizes, what is the stock price going to be at? I would argue much higher, okay? Now, the implications or applications for a mortgage purchase fell 7% for the week and went down 21% than the same one week a year ago. 21% down year over year. That is an awful drop in mortgage applications demand. I mean, that is just simply awful. But at the same time, deflationary. You guys have to understand that there's no good with bad here. We have to kind of assume that these bad news are now good news and kind of work backwards to get back to normal in the economy and the market. Okay, and then back to this here, moving on. High prices resolve themselves. The consumer is not stupid, guys. The consumer is smart in the U.S. and they make smart decisions. Most of them, I would say. Okay, and high prices resolve themselves. Okay, when something gets too high, I myself, I have a truck and I have a sedan, a economic sedan. When the price of oil gets too high, I find myself using that sedan more. Instead of taking the truck out to for shopping or for groceries, we're now taking the sedan to save more money. This is just a natural reaction to consumer that you can expect from myself and everybody else out there to make these decisions throughout the economy. That's deflationary on its own. And for the next one here, which is a little bit of a kind of like a hope kind of situation, is that China may realize that their zero tolerance policy is just not sustainable. Like I said, what are you doing, China? Get it together. Call somebody, get some Moderna and Pfizer over, and I think you're going to have a much better time. So again, not sustainable, but of course, hoping a little bit. Moving on here, we talk about the revenge travel phase, okay? We all know that everybody's been cooked up, or mostly everybody has been cooked up in their homes, and now they're going through what I call the revenge travel phase, in which it's like travel at any cost, no matter what, because we need to get out there and experience the world. People are doing that, but it's costing them an arm and a leg to do that. Hopefully, this passes, this kind of revenge travel phase passes, and we get back to a more normalized kind of travel kind of situation in the U.S. Moving on again, we're going to go to the Federal Reserve, and this is a little bit more hope. I'm hoping that they get more aggressive than previously thought because the data continues to evolve, because the reads are harder than expected. It means they have to be more aggressive than expected. And then here we're talking about vehicle production in the U.S. Vehicle production, rental cars, vehicle productions go hand in hand. That's one of the major drivers of inflation here in the U.S. But we have U.S. vehicle production ramping up. We have Ford ramping up, GM ramping up on electric vehicles that are deflationary themselves by nature. Hopefully that goes a lot faster than it's been. But we've heard from Ford, which we own that stock, that they're planning to double upon double production year after year, which is a great thing for our shareholders, and it's deflationary by nature. And finally, we're talking about supply chain onshoring, okay? When I'm talking about onshoring, supply chain onshoring, I'm talking about local competition. And when I say local, I'm talking within the U.S., not Chinese, Taiwan, or Vietnam. I'm talking about competition for manufacturing in the U.S. due to China supply uncertainty. Anybody who works in logistics know that Chinese supply chains are a mess. They will be a mess for quite some time. They need to get figured out. Their lockdowns, their zero tolerance policy needs to change. And in the U.S., we're creating car batteries, mines, semiconductor foundries, etc. And those will be deflationary by nature as well. So overall, everybody's worried about the economy. Are we going through a recession? Is it going to be a mild one, a heavy one, right? Who knows at the end of the day? But if you're really worried about the health of the economy, turn off the news and use my acronym, okay, which is the watch of the real economy, how to watch the real economy and how to look at the health of the economy. And I'm doing it through the acronym WATCH, which is Walmart, Amazon, Target, Costco, and Home Depot. Walmart is going to give you, if you listen to their conference calls, if you read their transcripts, their quarterly reports, they're going to tell you the health of the regular consumer. They're going to talk about it. You're going to get a good feel of the regular consumer. Amazon, you're going to get the idea of the e-commerce consumer. Target, mid to higher end consumer. Costco, regular to higher end consumer. And Home Depot for the health of housing. Okay, they're very important to listen to Home Depot for housing. Okay, so this is a little bit of a trick on how to really get the right idea on how the health of the consumer is the health of the overall economy in the U.S. And to close it up, guys, okay, my thoughts about the market. I just kind of want to give you guys here a summary of my thoughts about the markets, okay? So fundamentals in stocks right now don't matter. Right now, they just don't matter, but they will in the long term, and they always matter in the long term. So when we're thinking about balance sheets, growth rates, look at AMD reporting great numbers, increase in share buybacks by $4 billion to $8 billion. They're pretty much doubled their share buybacks. Market doesn't care. You could be Nvidia, you can be Tesla. The market doesn't care how good you are. It's all about a technical recession in the numbers, in stock behavior, in the technicals. If you don't understand technicals and you're listening to the Tesla conference call and the Tesla numbers and you're going, but they did a perfect, quarter, but it still dropped. The market doesn't care about that right now, the collective of the market, okay? And the market has priced in a lot of bad, guys. You have to consider that. A lot of bad has been priced in the market, even maybe a mild to moderate recession, but who knows? I would say probably closer to a mild recession. The market's already priced in, but when we're getting in the NASDAQ 30% oversold, how can you tell if it's a mild to moderate? I think it's a moderate. The NASDAQ is telling you moderate. The Dow's telling you it's mild. But, of course, you have to watch the markets to really understand this, okay? And then, of course, be long or go home. If you're not long this market, you need to take a vacation from this market. That is honestly my advice here. You can't be in there trading or expecting to buy Dutch Brothers and sell it a month later for 50%, which I got lucky at. I got lucky with that stock, but not everybody gets lucky that way. Who's getting 50% returns on their trades right now? And that's just me getting lucky rather than being good, okay? Too late, guys. It's too late. It's too late to bet against stocks. Too late to get bearish. That's already too late. Too late to sell your shares. If you sell your shares, when do you get back in? That's the problem. You're banking on these other major corrections, major moves on the market that may or may not come. So I think it's definitely too late to sell your shares. Bonds are still a joke, okay? It's not like you're this hedge fund that's going to sell your stock in Tesla and then move to a 10-year Treasury bond yield. It's still a joke at 3.15% where it's at. Here's the bond rates right here. Let's check them out. So 3.16 for the bond rates. It's still a joke against 8% rate of inflation. I mean, why would you even want to do that, okay? It's time to build your positions and be an investor, not a trader, speculator. We've been over this over and over again, okay? And do not chase the market rallies. Please do not chase the market rallies. This year is to build your positions. Wait for the market to puke, then pick your stocks. Pick stocks with strong balance sheets, great futures, great growth rates, okay, that are going to be disruptive, that are going to be here in another 3 to 5 years, no question, okay? So that's it for today, guys. That's all I got to say. I definitely appreciate you guys listening, giving your attention, welcoming me back after so long I'm not doing a video. Let me know if you guys have any questions. Instagram, Stocklighter, Discord, links below. Peace out.